I'm going to explain what home equity line of credit is and how it works. I'm also going to show you how to compare home equity line of credit to refinancing using something that's called blended rate. This is very important because most people don't know how to look at the combined cost of all their debt, and they end up making the wrong decisions. Also, I'm going to walk you through real examples with numbers so you can see exactly how this works in practice. And then I will give you my 3 rules for using HELOC safely so you don't not gamble on your home. So let's dive in. Let's start with the basic. What is home equity line of credit? A home equity line of credit is a revolving line of credit secured by your home. Think of it as like a big and flexible credit card secured against your house. You can pull money from it when you need it. You only pay an interest on what you actually use, and you can pay down and reuse it again and again. That is basic structure, secured by your home. It's super flexible. It can be interest only payment and rate that moves basically like your variable term mortgage with prime. Now, you might be thinking, why not just refinance my mortgage, pull all that equity out of it with a bigger mortgage? So this is a great question. During COVID, a lot of Canadians locked in very fixed low rate. Some people are sitting right now at 1.5 to 2.5% range. So if you use home equity line of credit, you keep that cheap first mortgage, only extra money. You're only accessing that extra money in the new rate. So to compare those two, you need to look at your blended rate. That's just a fancy way basically to say what interest rate I am paying across all my mortgage debt. So let me give you a small example. Let's say you have a $500,000 mortgage, you locked at 2%, and you need another $200,000 for, let's say you want to do some renovation. Maybe you want to actually invest that money or to clean up. So option 1, we can refinance everything into the new mortgage of $700,000, let's say at 4.5%. Or the option number 2, you keep your $500,000 at 2% and you only add $200,000 at 4.95%. So when you blend those two different options, is still much closer to lower 3 range than the 3.5 when you take home equity line of credit. So even though the home equity line of credit by itself is a high rate, your total cost of borrowing can still be lower because you have that low first mortgage. That's why for a lot of Canadians who still have a very low fixed rate on their first mortgage right now, a home equity line of credit can make more sense than breaking and getting a new mortgage. So in a minute, I'm going to walk you through a full example of using home equity line of credit to fund an investment property and how the cash flow needs to cover this home equity line of credit. But before we do that, we need to talk about when to use home equity line and when not to use it. Because HELOC is a powerful tool, but if you treat it like a free money, it can actually cost your home. When HELOC actually makes sense. And here are basically smart uses of home equity line of credit. If your home improvement that actually add value. So using home equity line of credit to renovate a kitchen, maybe add a bathroom, finish your basement. Those things will increase the value of your home, or you can actually rent that basement and make more money. So cleaning up a high interest rate debt. So let's say if you have credit card at 19 to 24% and you move that into your home equity line of credit that right now is under 5%, you can save a huge amount of interest if you stop using those credit cards. And Also for short-term projects and opportunities. So those can be rental properties down payment, a short-term business needs, or a project where you have a clear plan to pay that home equity line of credit money back in a few years. Now, let's walk through a simple Canadian example. So let's say your home is worth $700,000. You owe $300,000 on your first mortgage, which is 2%. You're going to set up a home equity line of credit for $250,000. You decide to use $200,000 from that home equity line of credit as a down payment on a rental property. You buy a small mall property, let's say for $800,000. You put $200,000 from home equity line of credit. You get $600,000 in mortgage. Because it's a rental, we're looking at a little bit of a premium, let's say at 4.5% fixed. The rent have to cover the rental mortgage, the home equity line of credit interest, property taxes, insurance, maintenance, and reserves. After all the expenses and loan payments, you still have to have close to positive monthly cash flow. That is the key of this whole idea. The assets you're buying with home equity line of credit has to be strong enough to pay HELOC for you. So if your numbers don't work when the rates are around 3 to 5% range, this deal is probably not good enough. Before I give you my 3 rules, I want to be clear about the risks. And the risks are significant. So the risk number 1, variable rate can go up. Home equity line of credit move with the prime. Most economists think we are closer to the bottom of the rate cycle than to the top, which means that we could see small moves either way. But you cannot count on big cuts from now on. You need to build if a prime rate goes up 1 to 2% scenario in your plan. Risk number 2, the lender can reduce or freeze your home equity line of credit. Yeah, they can eliminate. If the property value falls or if the lender risk appetite changes, they can freeze your available limit or in extreme case, ask for the partial pay down. So risk number 2, you can lose your home. And we saw that happening. A home equity line of credit is secured against your property. If you default, the lender can enforce on the house just like the mortgage. That's why we treat home equity line of credit like an extremely serious tool, not like a free spending money. All right, so here are my 3 rules for using home equity line of credit safely in Canada with today's rate environment. Rule number 1, use HELOC for short-term debt only. For me, short-term means you have a clear path to pay it off within about 3 years. If your plan is to carry home equity line of credit balance for the next 10 to 15 years, you are turning a flexible short-term tool into very expensive long-term debt. Rule number 2, stress test your payments. Before you borrow, you have to ask yourself, can I still afford this debt if my rate goes up by 2%? And if the answer is no, the amount is way too high for you, or the plan is way too aggressive. And the rule number 3, never borrow without a realistic exit. You have to have an exit plan. That exit might be refinance at a renewal, selling another property, proceed from the investment, or cash flow from a strong asset. If you take $100,000 from home equity line of credit, you should have a specific plan from where that $100,000 is going to come from to pay it all back. If you like this video, please hit that button and subscribe, and I'll see you in the next video.